So this is the 2015 DEB Incomplete Type B. So just a couple of things to look for at the bottom. So there is bad debt provision, there's depreciation, and there is bank, right? That's really important. It's bank overdraft, which makes it a liability, but there is bank. So that means we don't have to do the bank account working. So that's something we should now always check for when we're doing these questions. So first things first, we'll put in the amount we paid for the business into our capital and reserves. So, or not the amount we paid, the amount we lodged in the account. So the capital is 510,000. Okay, like so. Extra, I'm going to put in everything from the bottom. So I've got my stocks. So my closing stock is 33.4, which includes the oil of 400. So 33,000, and stock of oil is 400. And then I'm going to put in the closing stock over here as 33,000 as well. Just make sure you don't include the oil in the trading profit and loss account one. Okay, I'm going to put in my debtors. And my debtors is 29.5, and I'm going to deal with that bad debt provision. Okay, so I'll get that out of the way now. So the bad debt provision is 3%. So 3% of the 29.5 is minus 885. So that is debtors of 28,615. Straight away, that's an increase in bad debt provision. So that's out of the way now. That's been dealt with. So 885 has gone in. Okay, so we don't have to worry about that anymore. Trade creditors is I don't know why that's in red, but we'll just get rid of it. So the trade creditors is 17.2. The bank overdraft is 8.7. As I said, that's a great thing to see because it means you don't have to do a working for that. So again, bank. Most of these questions are you get a bank in the current assets. If it's an overdraft, it's a liability. Electricity due of 550 is going to be a liability. So from there, we go back up to the top and we'll start working out our goodwill as our first working. So the amount we paid for the business is 300 is purchased the business for 510. So it is the 510, and its value is the assets minus the liabilities. So we've got 350. Premises is an asset. We've got stock of 39,000, which is an asset, and we've debtors of 38.5, which is an asset. Rates prepaid is an asset. Equipment is an asset. A creditor is a liability. Wages due is a liability. And 4% investments are an asset. So that should be minus 1,400. Same mistakes I made in one of the previous questions. So the value of the business then is 429,300. So the goodwill is 80,700. I definitely left something out. That's way too big. So let me just check those again. So 350, 39, 38.5, 78, 25,000, minus 35.6, minus 1,400, and the investments were 60,000. So that's more like it. So the goodwill is 26,700. Okay, into its normal spot up there as a tangible fixed asset, intangible fixed asset. Okay, so from there we'll start at the top and we'll start working our way to the bottom. So premises. Now this is it's not that it's new, but he started off with premises costing 350. Now I don't see any depreciation of premises, which is fine, but it says on the first of the 9th he borrowed 180,000 together with 40,000 of his own money. So premises is 350 plus the 180,000 plus the 40,000 of his own money. Okay, so premises is 570,000. So we've got our premises in. There's no depreciation on the premises, so 570 there. So it was sort of new there, is normally the loan is more than the premises, but in this case he had to use some of his own money, and we'll have to deal with that 40,000 of his own money in a little while. The stock is 39,000, so we'll get that in. Excuse me. Opening stock. Debtor is 38.5, but debtors used to work out sales, so skip that. 9 months rates prepaid, which is an awful lot, but there's no reason why it couldn't be that. So we do our rates working. So we go and see what the rates is. Rates for 12 months is 11.6. That's 12 months. Now there's a prepaid at the start of the year for 9 months of 7,800. So that's equal to 9 months, okay? If there's a 9 months prepaid at the start of the year, there has to be the same amount of months prepaid at the end of the year. So that's also 9 months. So in this case, it's going to be 9/12 of 11.6, which is 8,700. So the rates then are 10.7. Before I go any further, I'll put in that rates prepaid of 8.7. Okay, before I even check if there's drawings. So I'll go down and check my drawings. Yeah, 20% of the rates payable is drawings. So we're going to take that 10.7, find 20% of it, and the drawings is 2,140, which would make your rates 10.7 minus 2,140 is 8,560. So the rates can go in as 8,560 as our expense, and from that now I've had my first drawing, so I'm going to start my drawings working. So we've got rates of 2,140. And every time now from here on in I come across drawings, I'm just going to put them in. Okay, next one is equipment. Now I know there's depreciation on equipment. 15% on equipment held at the end of the year. So you bought equipment costing 25,000. You bought further equipment costing 18,000. So it's 25 plus 18 is 43,000. So it's the 25 you started off with plus the 18 is 43,000. Then your depreciation on that. So you had depreciation on the equipment. You're given the months, so you have enough to work it out here. So depreciation rate is 15%. So it's 15% of something and 15% of something. And we're working about the two numbers. So for the first 3 months of the year, you had equipment costing 25,000. So it's 15% of 25,000 by 3 months. For the last 9 months of the year, once you bought the equipment on the whatever date it was, the 1st of the 4th, wasn't it? Yeah, the 1st of the 4th, your equipment went up to 43,000. So if you do out those sums, 15% of 25,000 by 3/12, and 15% of 43,000 by 9/12. I'm hoping this ends up as a nice number. You end up at 5,775. So that's your expense. Now it's the first year you're depreciating, so it's also your accumulated depreciation. Okay, so that's our equipment dealt with. Trade creditors, nothing to do. Wages due. There was none at the bottom of the question, so it ties in with general expenses. So if it's due at the start of the year, you're taking it away. So we're going to take away that 1,400 from our wages and general expenses. So it's 95,000 minus the 1,400. So the 95,000 there in my payments. That's 93,600. Okay, so I'm not going to worry about, unless there's, it does. I was going to say unless there's drawings, which of course there is. The payment for wages includes 4,200 for his own private use. So we have to take another 4,200 away from that. That'll get you down to 89,400, and then put the 4,200 into your drawings working wages or petrol or whatever we want to call it. Right? So that's our wages done. Now we've got 4% investments. So they're giving you the percentage, which means I'm going to have another line here probably. So which means you can work out the investment income as well. So 4% investments are 30,000. The investment income then is going to be 4% of 30,000, which is 1,200. And I'm going to write this down actually. So just investment income, 4% of 30,000, which is 1,200. What have we received? They normally tell you lodge some of the money. You've lodged 2,000. Doesn't make any sense. So I'm after taking the wrong figure. It's 60,000 there. So that couldn't be right. So if that's 2,400, don't know where I saw 30,000 there. So that's 2,400. So 4% of 60,000 is 2,400. We've received we've received 2,000, which means you're still due to get 400. Of course, it is possible that you'd receive more than what you're supposed to receive. Wouldn't be that likely. If it did, that of course would be investment income prepaid. But if you get to that point, always go back and have a check and see, is it possible you made a mistake like I did there? I don't know where I took the 30,000 from. Anyway, the investment income due is a current asset, and that is 400. I should put this 87 here as well. Okay, so that's my investments done. Investments in, investment income in, investment due in. Note that it's sales is 30, gross profit is 30% of sales. Then you're into your last bits and pieces. So your drawings, he's taking stock 120 a week. So 120 by 52. And that's purchases really. Actually, I'm going to call it purchases. So 120 by 52. He's taking cash of 230 a week. So 230 by 52. Which is 11,960. Okay, so the loan then. He's got a loan of 180,000. I will just check and see how he repays it. So he's repaying it in installments, 24 half-yearly installments, which makes it 12 years. So the loan is 180,000. He's going to pay 2 installments this year. The first one or next year. The first on the 1st of the 5th, second on the 1st of the 11th. So in effect, he's paying 1/12, 2/24. It's 1/12 of the loan back this year or in the coming year. So loan installment due will be 1/12 of 180,000, which is 15,000. So at the end of the year, he will owe 165,000. So it's the 180 minus the 15. So it always keeps adding up to 180. But he will pay 15,000 this year. After this year, he'll pay 165. So then we have our loan interest. So what's the rate? He's paying 5% per annum. So it's 5% of 180,000 for a year. But he only got the loan on the 1st of the 9th. So 9, 10, 11, 12. So that's 4 months. So 5% of 180,000 by 4/12 is 3,000. So that's his loan interest that he's going to have to pay. Let's see what he paid. It can be mentioned here. He's paid 2,500, which means he's still due to pay 500. So loan interest due, which is a liability, will go into your current liabilities. Now, the 3,000 will be an expense unless there's drawings to do with it. And there is 20% of it, of the 3,000, which is 600, is to do with the private section of the business. So that is drawings. So the drawings that we put that 600 in, and we're going to put the 2,400 into your expenses here. Okay, so that's dealt with. Now, I have to go back here. I skipped this together with 40,000 of his own funds. That is capital introduced. If he puts in 40,000 of his own funds, that's money he's putting into the business. Now, there's also capital introduced of this grant of 10,000. So he's putting in 50,000 in total. So that's 40,000 plus 10,000 that he's introducing into the business. Okay, so that's all that done. The grant is done. The investment interest is done. The payments, light and heat, we haven't done yet. So we'll do our light and heat working. So we'll start off with our rate 2. You would add on any stock of oil at the start if there was one. You would take away any light and heat due if there was any at the start. Then you go down to the bottom and you see there's a stock of oil at the bottom. So the stock of oil at the end is for next year. So we're going to take that away. See if there's any electricity due. There's 550. We're going to add that on. Okay, so that gives you 8,350 as your light and heat used. So from there, you need to see if there's drawings. So there you go, light and heat used, there's drawings, and it's 20%. 20% of the light and heat used, so for 1,350. Which is 1,670. So we'll put that 1,670 into our drawings working. And we'll put the difference then into our answer. So 6,680. Okay, so 6,680 up here. hopefully not too much more to go. Equipment we've done. Delivery vans we haven't done yet. The same process. There was no delivery vans at the start. You bought a delivery van on the 1st of the 8th for 24,000, and there is depreciation on them. So the depreciation on the van is 20% per annum. So it's 20% of the new van costing 24,000 that you got on the 1st of the 8th. So 8, 9, 10, 11, 12. So you have it for 5 months. Which is 2,000. So the depreciation on the van is 2,000. Which will be an expense. Should have put it in there first. So that's done. Wages we've done, rates we've done, and we've done this 4,200 in our drawings. So we've done our drawings, we've done our bad debt provision and depreciation, and we've got everything in. So it's just a matter now of totaling up the few extra little things that we have to put in, like our drawings, and getting them in. So the drawings is 26,810. So remember, drawings is a minus. And then I'm just going to call that capital employed. We need that in a minute. So I think we've everything in. So we're going to start totaling things. So as I'm going to say in all the videos, I'm going to make sure I add up my cost, depreciation, and my value for my fixed assets. And then my total fixed assets will be 629,225 plus 26,700 plus 60,000, which is 715,925. I've got my 5 current assets in, so I'll add them up. We get 71,115. My current liabilities 41950, which we'll take away from each other. That's 29,165, and we'll add that on to our fixed assets to get 745,090. Now I'm going to take that 745,090 and I'm going to put it down in my capital employed. Okay, and that's going to be the number I use to work out my net profit. So we're assuming this number is correct. So what we do is we have to work backwards. So we add back on the drawings and take away 3 positive figures, because 165 plus 510 plus 50 plus some number for net profit minus drawings equals this. So to find out what the net profit is, you just work backwards. So as I said, take away all of your numbers there, and you should get a profit of 46,900. Now, if you're looking at me saying, well, I took away drawings, I took away a minus drawings. So minus minus is plus. So I added it back on. Okay, so that's my 46,900, which I'm going to move over to my net profit over here. Again, working backwards, I'll add up my expenses. Hope I haven't made any mistake here. So our expenses are 115,700. So some number minus 115,700 equals 46,900. So to work backwards up the way, add them back on. So 162,600 minus 115,700 does equal 46,900. Same with this, work backwards. Some number plus 2,400 equals 162,600. So obviously just take it away. 160,200 plus 24, it does equal 162,600. So then that gross profit is 30% of sales. So we're going to take that 160, 200, divide by 30 and multiply by 100, and that's 534. And the difference between the two of those is our cost of sales, which is 373,800. So same as with the finding the net profit there, we're going to start with this 373,800. We're going to add back on the closing stock and take away the opening stock to find out what our purchases is. So it's 373,800. Add the 33,000 and take away the 39,000. That gives you 367,800. And then to find out what our purchases is, sorry, I have a different figure for purchases. 367,800. And then of course, remember to add back on the drawings to show what it is before the drawings. So the drawings of stock or the drawings of purchases is 6240. So if we add 6240 onto that, we'll get 374,040. So minus 6240. And that'll give you the correct answer. Okay, part C then, you're a little bit of theory. What's meant by an accounting concept? Well, an accounting concept is anything that guides us. It's the rules for accounting. So it's a rule that is applied in the preparation of your financial accounts, your financial statements. Illustrate how the accruals concept applies in the accounts of C. Clay. So the accruals concept is you account for stuff when it happens, not when it's paid for. And you could see the accruals concept to be involved in the rates prepaid. You could give that as your example. So the rates from your rates prepaid from last year gets added in, but you have a prepaid at the end of the year to get taken away. You could do the same with stocks. You could mention stocks, or you can mention electricity due. Okay, so the accruals concept is all about dues and prepayments. And name any other two fundamental concepts: going concern, prudence, and consistency are the other three. Okay, so hopefully you sort of start getting the same questions again with those theories as well. All right, that should do it.